Definitely. I'm on my vacation location. The family on in a small village on the Atlantic coast. Just trying doing this on the patio, and honestly, I don't know if you can see me that well, just because there's a lot of light right here. I'm not sure that I can be seen properly, but anyway, please let me know in the you can see me, you cannot hear me, or whatever. We'll figure that out. So today I'll try to do it quick, just because I don't have my usual setup. Um, and so it will be a little bit more difficult for me. I'll try to. I could not prepare, all the illustrations that I use usually. So I'll try to share my screen of things, and basically we'll go from there. So I have no idea uh, if this works today, because again the tech setup is different. Frankly, the internet connection is really shitty here. It's usually enough, I mean, to be able to manage my systems, because it allows me to connect to my servers in the US, and then manage and monitor my process now to stream videos and audios. And audio, it's obviously much more difficult. The bandwidth is small, uh, but I just hope it works. So we'll go ahead and figure that out. Again, if you cannot hear anything, just let me know. So what I'll try to do is to share my screen, uh, and well, let's see if that works. So I hope see me somewhere, somehow. What is it? It just doesn't work. I don't know. Maybe you can see me. Maybe you can. So let me stop this. Uh, Let me stop this, and we will start to be able to start. So again, so it's streaming. So yes. So let's start with geopolitics. The big geopolitical event this week was Israel striking Lebanon and Iran, which is obviously a major escalation into potentially a global conflict. Following this strike that killed the head of the Hamas, which is defined, as a terrorist organization that's on the October 7th. Iran informed the United Nations about its date in self-defense, according to the specific article, the Article 51 of the UN Charter. And the response from the UN, from the head of the UN, Antonio Guterres, it was confirmed that it was Iran's right to self-defense and then strike Israel. So basically, opens the door to a retaliation, kind of legal retaliation. I like this idea to fight a legal war. Personally, I find it's funny. All gloves are off when usually you have war, which is another thing. Just war crime is another kind of ironic thing, in my opinion. Um, so we see major escalation is a potential to escalate into a global conflict, because obviously if Iran goes into direct conflict with Israel, that involves the US, and then that involves Russia as well, and potentially China. So after that, all countries are preparing for major escalation. You had France asking citizens to leave Iran immediately. You had Turkey as well intervening. The issue is you actually never know which sides they are, because they are officially in NATO, but they are also Muslim countries supporting the Palestinian and Iran. There's also, it's obviously much more complicated than that. In Islam, Kia and um, sorry, I don't. Uh, I don't remember the other one, but basically, if you know, you know. There's a split in Islam between two sides, between Iran and Saudi Arabia. If you want to talk geopolitically, but anyway, so I mean, there's a big risk now. The possibility is that I'm not sure about the willingness of Iran trying to actually really strike Israel in a massive way. You know, they always threaten that they will launch a nuclear strike against Israel. I don't think they will. They'll probably try to hit some military objectives, because the reason is that if they actually try to do that, they also probably they obviously know their regime. If you go there, I mean, the first, so Israel will strike, the US will strike. Basically, they will carpet bomb the country, just like they did in Iraq, in Afghanistan. Even if Russia intervenes to support them, the conflict will be located in Iran. Obviously, and this means the end of this regime we know it. So I mean, most of the regimes therefore. So I don't think they would escalate massively. At least this is the hope that I have. Otherwise, we have World War III, and that's how it works. I would just check, because again, it is not my usual setup. So I hope you see me or something when uh, I that would be great if if you actually see this when I speak, or if you see a blank screen when I switch to another. So yeah, so I will continue again. Like I said, I will do it short and sweet. Economy next. So you've seen the economic data. So the economic data around the world kind of screams recession. China, its economy suffering from weak internal demand. In the US, I mean, the soft landing narrative is collapsing with a slump in what we've seen is the Institute for Supply Management Manufacturing Index. Sorry. So we had the rise in weekly job claims to the highest of the year, and yesterday we have disappointing record, which means that we are progressively and more obviously head recession. This is something that I've noted, before, and basically I think that's given again the job market statistics that we've seen, that always revised down. The only thing that is keeping this number up is the government hiring. More than half of the job created are government related, which means directly government. The rest is variant level and even level destructions at some point. Um, so obviously, we're heading into a recession. Again, fake job data's revisions lower again. Now the last one of the last statistics that we had this week was a contract in manufacturing. On top of that, you have the tech bubble is bursting. So that doesn't look good. It looks at this point that the Fed might cut kind of in panic mode at that point in September. If you remember, the interest rate cut expectation were about 25 bips, if I remember well, as maybe 1 2 3 weeks ago. Of this week's is priced at 50 bips, 50 bips rate cuts in September, and so already talking about if it continues let's say between two Fed announcements, between two Fed meetings, some extra 50 bips rate. So, and usually, I mean, for the market, because it just shows that um, the Fed basically and did something too late, or and too fast, of which is, the Fed is always reacting. I mean, even they have, I don't remember how many, they have more than 400 PhDs for working for them, something like this, and none of them can figure out the common sense stuff. I would say I don't say that I would do a better job, to be honest. Probably do a much worse job. But there are some kind of common sense things that everyone seems to see, and they don't. So if they don't see it, maybe they just don't want to see it if that comes obvious to many people. So we can probably, again, I'm happy about myself, because so until now I never really managed to do this in a couple of minutes, 15 or 30 minutes. It looks like I will do it now. So now let's switch to the markets. uh, Again, I'm sorry, I have no idea if it works, but let's do this. So I'll try to share my screen and read my notes on another one. Ah, I think that will be funny. Okay, so I hope you see this. Okay, that works. That seems to work. Okay, bear with me, guys. I'm just trying to do something that just doesn't work. Um, oh, it works actually. Okay, so that seems to be pretty cool. So the markets, basically, so you've seen the statistics, the economy statistics that are not good. So there are two things that, in my opinion, that are playing in the market, the drop this week. So obviously, you have bigger concern about growth in the world. All the valuations from specific sector going up like crazy, which are, don't forget that they are expectations about the future that actually may not realize. So maybe, so you have two things. So these expectations may not be as close future as they are. That's one point. And like, you know does this work? Showing this. So where do I have this? So yes, this is the commodity index, and another one that I want to show you with this. So basically, I think that the oil is actually an indicator of the expectation of the economy to grow and to function, basically, which comes from the oil. Meaning we have not transitioned to anything like electricity anyway. So oil is not going up, despite, again, the conflict in the Middle East. So it's not going anywhere. It's mostly going down. It's in a wedge so far. We have no idea where it will go. It may go, depending on the conflict. Actually, um, or down, depending on the issue, global expectation about the economy. Now, if you look at the commodity index, global commodity index, it's not any better. So for the economy to grow and produce something, you may not need energy and raw materials, and both are down and are not looking to be going up at this point, which is, I don't even expect. It's kind of the thing that I see, which is that the market is actually telling you what you need to know. Again, lower price, and on top of that, you also have. Do I have it on my screen? Yes, this is gold. So gold, as you can see, is still sticking to its all-time high. It's it's linked to which is that it's supposed to go up when the market is not doing so well. But at the same time, we have some expectation on the Fed on potentially lowering interest rate to support. This means again inflation in a second wave inflation. Sometimes I compare this to what happened in the 70s, and which we had two waves of inflation. The first when first one, and then after a quick correction in inflation, the Fed said, "Okay, we have won the fight against inflation, just like today," and started decreasing, and the up again. And this is kind of things. So again, it makes sense that gold is sticking on the upside for inflation and for kind of a move to a safe asset. What can I tell you more about this? Let me check my notes. Yeah, the thing that what I've seen, and so the guy that I've checked was saying that why? Because both were election years, and both had huge bubbles. We had the tech in 2000, so we have the tech today and AI, and we had subprime in 2008. We had the of funds, uh, 5%. Just as a reminder, in 2008 we dropped 5% in August, 20% in September. Again, if you remember what I showed you last week, I showed you the season of volatility. We had a bottom at the end of July, then it rises up in August, which makes sense considering the low volume of market. So you can expect volatility. The markets are much more manipulable. It's much easier manipulated when you have low liquidity, and usually when everyone goes back to school in September, it's always a more elevated volatility time, and you have very often crisis, the heightened the in October. So what happened in 2008 again? We dropped 5% in August, 20% in September. Then Obama was elected, and we bottomed at minus 50% in a 50% drawdown on inauguration day. And as a reminder, the Fed dropped interest rate from 5% to 0% in 3 months to be able to support the market, and then it was infinity had propelled this next bubble. So I mentioned this, the about the reason for the correction this week. So it was poor economic data. There was another major reason, in my opinion, which is I don't have any chart, I believe, to show you about this. We'll talk about term structure rapidly, but the second part is probably the carry trade. So we were mentioning, that the yen being really weak gives risk on the carry trade and winding of the carry trade. The thing is that Japan, well, why? Because when you have assets, you have borrowed in Japan to invest in higher yielding assets, bonds or stocks being down massively, then at this point you lose on your exchange position, or even if you're hedged. But this can trigger the unwind of the carry trade, and the carry trade is the thing is that it's basically you're collecting pennies in front of steamroller. It's I always say this: you have two kind of positions. is long. You are either long or short volatility, and the carry trade is a short volatility position. And when it unwinds, you basically can get very very rapidly, and this is what happened basically with the crash of the yen recently. Where is it? Yes, no, that's the Nikkei, and that's the yen. So you've seen the uh, correcting up massively. So the dollar week is stronger after the Bank of Japan increased by 25 bips, I believe. The interest rates. It doesn't seem big, but for them it's really big because um, if I remember well, if their interest rates rise up by 1%, this means that their deficit doubles. 5 let's say unmatched. It's kind of huge. So basically, we have this move, potentially the unwinding of the carry trade, which means that if you unwind the carry trade, you have to sell the position that you bought abroad, let's say from yen. So which means that you would have to sell your U.S. asset, whether it's bond, whether it's stocks. So a combination of both the unwinding of the kid and the poor economic data and concerns about the future global growth that generated this. It's always a big deal because we are now at an inflection point. This is what I wanted to show you, the VIX term structure. I show this quite regularly to you when we are. Oh, there's a pet. uh, okay, let's try to continue. So usually the term structure is in contango, so it's going slightly up, which is a normal way of the term structure to be, because the risk is obviously in the future than it is now. If you are in the instant, the risk well, is what it is. It's lower. You don't have the potential for risk, at least in the future. Seeing that the October maturity, which includes the election, because it options until mid-November. It was a big bump at that point, expecting a larger, kind of significant event or surprise at this point, or at least something what made around the election, which might. So we have this really big hill in October. Now you see that the first term of the term structure has risen up to that level, which is kind of very significant. So now is much bigger in the future. What they expect, does this mean is that the future, the risk right now is big, and this will calm down in the future. So the risk is considered major at this point, which means that obviously markets price a risk that it goes potentially worse uh, next week or month. This is the kind of situation where you really have to pay attention, because you first maturities basically they are flat. The only reason they are flat is because you have in October it should be lower, and these are usually crisis mode term structure where the in future. Uh, what does it say about what the market do? Actually, not much, but it shows you that market participants are very concerned at this point about how the current situation will evolve, either in the market based on and market on the uh, and a geopolitical situation with point. So what else can I tell you about this? We have Bitcoin here. So Bitcoin is still evolving in its big flag. So we have between a range today between, let's say, 69 and $60,000. Basically, any win is insignificant. We'll see where that goes. Given the pressure that, well, that Trump is for Bitcoin. Well, for Bitcoin, at least to use this inside reserve as a technology that the US should be a leader and not restricted, which I totally agree with this. Obviously, I think that that's the main thing that I don't. Well, I do understand why the current administration does that, but I mean, if you cut yourself from a major technology that will drive to really perspective or what you think about Bitcoin as a real asset. So I don't want to say anything because, again, everything that I say is not an investment advice. This is a market comment. So basically, this is where we are. I showed you this commodity index first. We've talked about it rapidly about gold. What is it? This is the Nasdaq 100. So Nasdaq 100. So you see the correction. I mean, it's a significant correction, but at the same time, it comes after a really big up move. So it's not at this point, even if we are 10+%. Yeah, because so yeah, I've seen this yesterday. So some are saying it's a correction above 10%, and I don't remember how they call this between 20%. It's just, I mean, this label about fixed numbers 10, 20. I always find it funny. It's kind of meaningless, but anyway. So you have the oil, and then you have the volatility. Man, I mean, these guys, I mean, you have kids running in moped around and making a lot of noise. So you have VIX spiking up at this point. It's a really significant go. It's breaking out. If you see, so I didn't put 2018. It can it can escalate pretty rapidly. So what do I have? Oh, I turn around. Okay, so we have the volatility. We've so I've shown you everything. I don't know if I can say much more. Let me check if I have questions from there. Again, I'm sorry. It's a little bit hectic today. Okay. Okay, so yeah, I mean, so the only question now is it can escalate pretty rapidly from there. So the only question is that how you are you prepared? If you only long equities and there's a big risk, that might be an issue. And again, I think that because of the probably, I believe personally that the future will be much more volatile than it has been since 2008, for instance. 2008, we've went to QE infinity, and I believe we come at the end of this process, simply because you can print, yes, but to what point? There is a point that Basically your debt is meaningless. This is your on your let's say on your credit risk, basically. This will trigger massive inflation, which is a way to reimburse the debt. Not the right way. It's not default, but it's a kind of a technical default, if you like. Which also means that at the end of the day, no one will buy the US debt. Only the US government will buy the US debt by printing, which is not a viable solution. Next step is that you cannot tax it anyway, because I don't know what you see yourself, but around me, I can see a lot of people struggling. So you cannot tax more. We tax a little bit more the middle class in the US, and I've read something about taxing the even if you take all the money from all the billionaires you have in the US, basically you could probably, I don't have a number in mind, but you could probably have 100 days of the US debt. If you have, so the US debt has reached 100 billion in 3 days. So I've seen this a couple of days ago. So this is the rate at which we are increasing the US debt at this point. So you can take all the money from the billionaires that you want. It will only kill the economic activity, but it will not solve the issue on the US debt. Okay. I really thought, I'm sorry if I was a messy in what I was trying to say. I was probably not as prepared as usual. Again, it's not my usual location and preparation. I mean, ideal setup to prepare. But first, honestly, I didn't want to. I wanted to skip this one and stay calmly for the family with the family. But since we had that kind of activity on the markets this week, I thought it was cool to do another one and give you again my little view about where this goes. Well, not where this goes, but where we're at this point. Again, if I can repeat, the expression for this week was, concern about global economic growth, risk of the risk of the geopolitical risk in Israel. I think that were the three main drivers, and obviously this will develop over the next week. So what can I tell you about what happens now? So if I look at my system, and again, it's not an offer to buy a product, it's not an investment advice, but just to tell you, I have well, the way I run my strategies, there are multi-strat strategies where I combine a lot of different type of sub strategies. There's CTA, there's a tactical asset allocation strategy, there's a relative value strategy, and there's a little bit of I would say crypto, but like the NFA told me to say, it's an ETF basically. So you have to directly spot crypto. It's ETF Bitcoin, produce the Ethereum ETF as well. But the reason that I say that is because if you look specifically at the volatility, this one is the status of the strategy is really mixed. What I mean by mixed is that most of the time it spend its time in let's say short vol mode, because that's actually the status of the market, basically US equity market going up more. But now it's basically flat and it's ready to take some more long position a potential crash in the market. So it's long volatility position to hedge the market. But if the market is going further down, the hedge will be in full force very soon. And this is how it would work. So my point about this is that we seem to be at an inflection point at this time. So it sounds like, say it's, either or it goes lower, but it's never been true. We are an inflection point where there is a significant risk that the market is go lower. I'm not saying, again, not an investment advice, I'm not saying that it's going lower. I'm just saying that the risk of going lower and much lower is higher than it was before. So okay, I feel so here. That's cool to hear you, man. Where are you? How can I show this? I don't know. Just doesn't seem to work. Where are you? Okay. No, it's just slow actually, because like I said, I mean the correction is already so. So Atilio, very happy to see you again. I hope my intervention was not too messy. We live from here. Is happy to see you. I know Kyle is here. So thank you again, guys, for being here. I just hope that you get some interesting perspective about the market. At least it can help you to make good decisions for yourself. But I will go back to my for me, just because I always have to monitor the systems and make sure that the process run correctly and monitor the markets anyway. But at least I can take a little bit of rest and enjoy the family time. So thank you for being here. I might do another one next week. Maybe I will, maybe not. It really depends on how the markets will evolve. If it gets critical from there, if markets are rebounding, nobody will care. So I'll probably skip it and enjoy my vacation a little bit more. But if the markets are going down, probably I will try to do a little stream again, just to keep you updated and hopefully give you some information. Thank you. Enjoy your weekend and maybe see you next week.